Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
Hey, one of Wall Street's bond kings is spotting overpriced assets almost everywhere that he looks. In an episode of the Odd Lots podcast recorded to mark the show's 10-year anniversary, Jeff Gundlach called out nosebleed valuations in the equity market. He also warned investors, Tim, against incredibly speculative bets.
The Double Line Capital founder joined the hosts of Odd Lots, Joe Weisenthal and Tracy Alloway.
In recent years, the garbage lending has not gone to the public markets. The garbage lending has gone to these private markets. Next big crisis in the financial markets is going to be private credit. It has the same trappings as subprime mortgage repackaging had back in 2006. The health of the equity market in the United States it's among the least healthy in my entire career. In terms of the PE ratio, the CAPE ratio, all the classic valuation metrics are off the charts.
All right, just three snippets from that interview. That's Double Line Capital founder Jeff Gundlach with the hosts of Odd Lots, Joe Weisenthal and Tracy Alloway. Highly recommend you check it out on the Bloomberg and at Bloomberg.com. We want to stay on the markets and the outlook for financial assets in particular, and what is kind of a tricky time it feels like for U.S. financial markets. Great to have with us Chris Whalen. He's chairman of Whalen Global Advisors. He's also editor of the Institutional Risk Analyst. It's a weekly newsletter that looks at the intersection of financial markets and public policy. It dissects and analyzes bank balance sheets. Chris is author of Inflated, Money, Debt, and the American Dream, among others. That book, originally published back in 2010, second edition released in May of this year. We could go on his background. He's so well known to the Bloomberg audience, and he really was a go-to us during the great financial crisis. Chris joins us here in New York. Chris, it is great to have you here, and I feel like there are so many places to begin with. And I kind of want to begin with what we just heard from some of the interview that Jeff Gundlach did with the Odd Lots team, how he's keeping his strategy simple, loading up on cash, staying away from private credit due to garbage lending and unhealthy valuations, his words. The notes you shared with our team, you point out in the credit markets, the wreckage in private equity and credit continues to accumulate. Wreckage is a big word in my world. So what do you mean by wreckage?
The loss rates on many of these assets, Carol, and thank you for having me, is quite astounding. Remember that you had not just big private equity firms diving into private credit, but you had retail firms selling this to individual investors for the past couple of years. I think it just speaks to a decline in standards in the investment world. I've been an investment banker for 30 years, member of FINRA. And I got to tell you, most of my astute clients, the banks I really have respect for, don't see anything that they like. They're using the private markets to lay off credit risk. They're selling assets to raise cash. And I think that's frankly very consistent with what Jeff Gundlach is saying, which is that there's so much out there that needs to be fixed. And the loss rates could be rather considerable. So I think it's only getting started. You saw the story on Bloomberg this morning about Blue Owl. Yeah. We're going to see a lot more of that. So, just take that example and multiply it across the entire spectrum of private equity. One of the interesting statistics I saw in the last couple of weeks is that something like 2/3 of the existing private equity firms are never going to be able to raise money again because the losses on their portfolio are so profound. So I think we're seeing something episodic. And as Gundlach said, this is a commercial story this time. This is not about consumers and mortgages. This is purely institutional.
So the question I have is how it manifests. And do you believe it manifests in some sort of crisis? Does it become something that is systemic and has an effect on the entire financial system? Is it that big of an issue?
It is that big, but remember, this is institutional investors. So a lot of it goes on behind the scenes. lawyers and bankers sitting in conference rooms trying to figure out how to extract value from a situation. So when it impacts a public company, yes. When a bank has to fess up about a loss, you just saw one with Blackstone, a telecom company, which is going to cost them $150 million. Looks like the whole thing was a fraud from the word go. But over time, yes, you're going to see more disclosure from the public players, but the amount of loss is going to be much larger than what the typical investor, the typical media person actually sees, because so much of it is private. I'll give you an example. There's a really great publication called The Real Deal that covers commercial real estate. They can't even begin to cover all of the things that are going on. If you just read their headlines every morning, you get a sense for just how much restructuring there is going on in some pretty important and well-located assets here in New York City and other cities around the U.S., and it just continues. And yet the funny part is you have new investors jumping in to buy these assets after they've been marked down, thinking that they're getting a deal. Well, we'll see,
Well, we will see, right? I mean, does the AI spending frenzy play into this?
Oh, very much. I covered Silicon Valley for years, Carol, as a banker.
Right.
And I have a lot of respect for real technologists as opposed to salespeople. I don't think AI, as it's described to most investors today, is going to amount to anything except the convenience for consumer users of the internet. When you talk about real intelligence on the part of a machine that is based on its ability to observe and integrate new information, that's not what we're doing here. We're simply taking existing language, existing words, and putting massive horsepower behind search.
Okay, so
they summarize the first page of Google results. That's it.
So to be fair, to make sure I understand this right, you're arguing that what we're seeing right now with LLMs such as ChatGPT from OpenAI and Claude from Anthropic, that's the extent of the innovation that we're going to see when it comes to the investment in AI.
The head of AI at Meta, who's a really smart man, I was watching some of his videos yesterday over the weekend, and he just dismisses this entire phase. And I understand what he's talking about. I used to cover companies that did what we called natural language processing, where we were trying to teach computers words and then be able to integrate those words. We're not even doing that with AI. We're just simply throwing muscular search at it and saying, okay, what's the top 10 search results? Let's build a summary. That's not intelligence. So I think a lot of the spend, and you've heard this from other people, is going to end up being wasted when it comes to AI.
That's a lot of money, and that's a lot of big bets that, in your view, will not.
Don't get me wrong. I've made a lot of money on Nvidia.
Sorry, go ahead.
Well, I don't think it will generate revenue proportional to the spend. Let's put it that way.
So. Okay, so
I made a lot of money on Nvidia. Don't get me wrong, and I love that stock. I love the company, but I think the desire for investable assets has just overwhelmed these opportunities. We see inflation everywhere we look in the financial markets today, and that is defined as too much money chasing too few opportunities.
I want to push back a little bit, Chris. I've been talking about this piece that was on 60 Minutes last night about the founder of Anthropic.
Yeah, Dario Amodei.
Right, and he talks specifically about how AI in healthcare. And I've talked to doctors too. We just did, actually, even on Friday, we were at Boston Children's about the use of they can't keep up to date on everything, and that how AI can data points and so on really come together to help create in terms of diagnoses, treatment, and also in terms of innovation. But Amodei saying on 60 Minutes, basically he's talking about this thing of condensing basically Let me just look what he says. The compressed 21st century. That's the phrase he uses to describe what could happen. He says the idea would be the point that we can get AI systems to this level of power where they're able to work with the best human scientists. Could we get 10 times the rate of progress and therefore compress all the medical progress that's going to happen throughout the entire 21st century in 5 or 10 years? I realize it's his book, but I mean, those of us who've started playing around with it are kind of blown away with it in terms of what it can do. But again, do you think it's just a productivity tool or something more that maybe creates?
At this stage, yes. It's, remember in the old days, right, Chris Weil was one of the early advocates of AI. And he said, well, it's not intelligence, it's simulated cognition. And he was right. But then he had so many people throwing money at him to go to conferences and speak that over time he adopted a more liberal, more, I guess, accepting view of this technological phenomenon. But to me as a writer, when I use AI, I use Google, for example, it's nice if you know what you're looking for specifically, but I'll always ask the machine 2 or 3 times the same question, differently worded.
Yeah.
And you always get different outputs. So let me give you another example. Imagine using AI for a mortgage lender to deal with customers who are calling, for a variety of reasons, and you want to use it to try and sift through those inquiries, answer the ones that you can in a reliable fashion, also use it to do summations of phone calls that have to be reviewed and okayed before they're, finalized, right? These are all valid functions. But ultimately, all we're really doing here is summarizing. And that's what computers do. They sort, they do summations and averages and everything else. But it's not intelligence. It's not the ability to learn on the fly, and particularly without a monitor and a companion, if you will, in a human sense. So for a lot of companies, they look at the horsepower, they look at the speed and the robustness of these AI tools, right? But they don't quite get there in terms of rolling it out because of the high error rates.
Well, so
that's the thing.
Okay, Tim and I are like fighting who gets to ask the next question. Go ahead, Tim, because I'm gracious.
So are you out of Nvidia then? Because if this doesn't amount to,
everybody seems to be getting.
Yeah,
a lot of people.
I got in a long while ago. I wrote it up, then I got out, then I got back in, and each time it went up so much, it got to be such a big percentage of my portfolio that I had to sell it.
Well, the thing I want to ask you, Chris, is how does this end? Because I'm looking at a day where Amazon did their first U.S. dollar bond offering in 3 years, looking to raise $12 billion, but it tracks about $80 billion of orders.
$15 billion, the size of U.S. dollar bond offering at $15 billion.
It's like, and Meta did it. Like, so how does this end? I mean it when we turned to you so many times during the great financial crisis. And this was something that there was so much FOMO and people, didn't want to miss the gains, but we know how it all ended. So how do you, I don't want to be alarmist, I want to be smart here. How does this potentially end? The AI component, who's impacted?
I think you're going to see a correction in some of these valuations simply because they've gone up so much in a relatively short period of time. Let me give you another interesting example. Company I actually like a lot, SoFi. SoFi is the best performing bank stock in the United States. It has been for the last 18 months. You know what the next one is, by the way, among big banks? Citi. The rest of the big guys have fallen behind. So why did SoFi do so well? Well, slowly they're growing into their overhead. Their overhead was massive. It's still too high relative to the size of the bank. It's about $50 billion in assets now. But they had a tech component, a Silicon Valley component, a little bit of Bitcoin, all of these pieces that made equity managers love it. And they drove the thing up over 100% over the last 12 months. I think stories like that are going to cool off. I think Bitcoin, frankly, is in big trouble because it was kind of co-opted by Wall Street. When you see ETFs with Bitcoin, that's not a good thing. This was supposed to be a means of exchange, remember?
Well,
so I think all of these markets are going to have to retreat a little bit, Carol. Will they go down way much like 2008? No, because there's still too many dollars chasing these opportunities.
Yeah, there's a lot of liquidity out there. Chris, so glad already. My team is like, when can we get Chris back? Thank you so much. Really appreciate
time to
it.
rebook him. We have lots of follow-up questions.
We have lots of follow-up. SoFi, by the way, is up it's up about 74% year to date. Citigroup's up about 40%. Comparison, JP Morgan, also having a good year, but a gain of about 25% year to date. Chris Whalen, thank you. So appreciate it. Chris is chairman of Whalen Global Advisors, author of Inflated Money, Debt, and the American Dream, which we didn't even get to talk about.
That's why we're going to rebook him.
Because it's so relevant to today. Coming up, the CEO of Generac. That's next.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, we want to switch gears, talk a little bit about the company Generac. Shares of Generac are well off their highs this year, drop of nearly 30% since mid-August, and slumping about 21% since the company reported earnings late October. Now, those earnings from the power equipment company, you know who they are. They make generators and a lot more stuff. Included the company cutting its adjusted EBITDA margin and net sales growth forecast for the full year. The firm also posted adjusted profit and net sales for the third quarter that fell short of expectations. We had so much fun last time. Matt was here, Matt Miller, and we talked with the company's chairman and CEO and president, and he's back with us to talk about the business and the outlook. He is Aaron Yechfeld. He is, as we said, the president, CEO, and chairman of Generac, and he joins us from Wisconsin. Aaron, it is good to have you back here on Bloomberg Businessweek Daily. How are you?
Good. How are you guys doing?
Doing okay. I can't believe that it's already November of 2025.
I know.
It's been a lot. Hey, talk to us about earnings, because investors seem pretty disappointed in the results. What do we need to know now that it's a couple weeks since?
Yeah. So, we have two parts of our business, right? The part that probably most people know us for, the residential machines that we build here in Wisconsin and around the U.S., home backup systems. It was a soft season this year, really driven by two things. I would say the first thing is just we actually had really nice weather most of the summer and the fall. No landed hurricanes, which is great for the people who live along the coast. But if you're in a business like ours, obviously that does impact demand. So demand was softer just on the back of, basically nicer weather. And secondarily, we're starting to see some demand destruction, I think, with the consumer. We've had to put more pricing into the marketplace over the last 5 years, coming off of COVID, response to the tariff environment today. And that is starting to wear on the consumer and starting to impact our business a bit. The
demand destruction that you're talking about, I want to home in on that a little bit. What specifically is being hurt right now? Is it the purchasing power of the consumer? Talk a little bit more about that, what you're seeing in the marketplace right now.
No, thanks, Tim. And specifically for us, this is a home improvement project, right? For the most part. So because it's tied to the home and investment in the home, I think, I think housing just in general has just been slower, right? So the number of sales and purchases of homes, new construction of homes, all of those statistics are lower than I think where we'd like to see them at this point. We're not making enough housing in this country, unfortunately, and people investing in their homes, picking those types of projects. I think there's just a reticent right now, given some uncertainty. Just where's the economy headed more broadly as we turn the page on 2025.
Are you a little bit more subdued then, like as you look into 2026? I mean, it's just around the corner here.
Certainly in our residential business, I would say that's the case. I think, interestingly enough, in our commercial and industrial business, where we make larger generators for backup manufacturing plants, hospitals, hotels, and data centers, which is a new market for us, we're actually seeing, some very nice indicators of strength, obviously on all of the CapEx spending in data centers in that market, with being driven by AI, of course, as you guys have reported and everybody's reporting on. But we're getting swept up in that a bit. And that is, I think, going to offset largely, be a nice counterweight for what we do and what we're probably going to see here in the residential market.
What is the connection between severe weather patterns, outages, and then, a few weeks or a few months later, your own sales?
Yeah, typically for us, what you would see, so if you wind the clock back to last year, we had a very strong hurricane season, 3 landed storms starting in July, and then we had 2 storms in October and one in October, one in November. Typically, you would see a pattern of increased demand for a couple of quarters after that, which we did see first half of last year and kind of coming actually into the season this year. in anticipation for another season we thought was going to be active based on all the long-range forecasts. But it just didn't play out that way. So the weather patterns were a lot more mild, and as a result, we didn't see products sell through at the same rate.
Hey, I want to take a bigger kind of step back and look at the big picture environment of what you sell into, the U.S. energy grid. Because we talk a lot each and every day about the new data centers that are coming online, the increased demand that we're seeing, not just from consumers, but from companies when it comes to energy, increasing energy prices. And we understand the grid is definitely cobbled together, and what a grid looks like in one community is not what it looks like in another community. But how would you characterize the resilience of the U.S. energy grid right now?
Well, they do grade the grid, and they grade a lot of the major infrastructure every year. And I think the grid got a D this year. So, I think when you look at that's a report from the civil engineers,
who we should note are the ones who want to be, building this stuff.
Exactly,
so we have to take those grades with a grain of salt, I think.
Well, I think you're right on that, but still, nonetheless, outages have been on the rise, right? Maybe this year, this past season was a pretty mild one, but outages are on the rise in terms of the frequency of the outages and also the duration. And, it used to be weather delivered a lot of those knockout punches to the grid in terms of 80% of all outages caused by something driven by weather directly, hurricanes, ice storms, things like that. What we've been seeing is an ongoing trend here, a trend that's been forming around outages that are happening because you've got constraints of supply where demand is overwhelming supply. If you go back, probably the best case we can give you as example is February of 2021 in Texas with the freeze down there, right? So you had just very cold, temperatures down in Texas, not historically cold, but very cold. And all of the heat is, either electrical in nature, heat pump or baseboard heating. And it overwhelmed the amount of supply that was available. And what you saw there is ERCOT, the grid operator, was, they basically had to make a tough choice to turn everybody off. They took the decision to disconnect, millions of homes and businesses to save, the major elements of the grid from long-term destruction. And so we're seeing these types of patterns. You mentioned we're seeing demand growing at a rate that we haven't seen in 2 decades. So, they're only talking about a couple of percentage points increase, and it sounds like something small to you and I. But when you talk about the grid in kind of the greater context, a couple of percentage points of increases in demand is a lot. It's projected, especially when you look at the data center build out, 100 gigawatts of power is going to be needed over the next 5 years. And so, that's like the equivalent of adding 20 New York cities. So if you think about just the amount of power that is the raw power on the grid that's going to be needed. And it's happening at a time when we're actually retiring a lot of older assets, coal-fired plants and some other things like that.
Well, one thing I want to ask you, Aaron, just to provide some synergy with our earlier guest, Chris Whalen of Whalen Global Advisors, someone who we've talked to since the great financial crisis. He analyzes banks, the financial system, but we talked a lot about AI and the spend that's going on. And he's got a little bit more subdued view of the impact that AI will have on us longer term, that maybe it won't be as innovative or disruptive as some are saying. If it's not, how do you think about that? That what if it isn't as big as everybody says? How do you as a CEO of a company think about smartly what your exposure, what your build, or what your spend should be in exposure to that, when there is still the TBD is a big TBD?
Yeah, no, I'm sure as the case with Generac and other companies, a lot of boardroom conversations around this topic, right? Is it a bubble? How long will it last? Is it a 5-year run, a 10-year run, a 2-year run? I think what we know now, and we can look at our own business, how we're deploying AI, right? So we're using AI in our operations, in the manufacturing floor. We're using it in our customer support functions. We're using it across the business to drive optimizations. And we're doing that as a trade-off for adding heads, right? So I think a lot of businesses are looking at AI as a way to, can we gain enough efficiencies where we don't have to add as many new heads into the business? And so I think those trends are very well pronounced. In fact, we have a bunch of conversations and a lot of projects that are ongoing to utilize AI in that fashion. So I look inward and we see we're using it, and we see a lot of opportunity in the future to use AI even more deeply in our operations. And every company in America is going through this same process, large and small. And I think personally, I think this is something that is a game changer, obviously, for businesses and the way we are productive and how productive we can be as a business, and the impact it can have on our customers and the impacts it can have on our products as well. So, when I look at that and you look at the kind of game-changing nature of it, I think even if let's say for the sake of argument that maybe it's not going to play out over the next 2 years the same way we all, different forecasts have said it's going to be, dramatically higher than anything we've ever seen. Let's say it doesn't turn out that way. I do think over time, you're talking about this is a game changer in terms of the technology and the way it's being deployed. And I don't think there's any reason to believe that this isn't going to be something that's going to, obviously have a tremendous amount of spending underpinning it for a long time.
But the connection to your business and what it does for people and companies that want to buy machines from Generac, does it mean the grid becomes more resilient and more reliable because it needs these upgrades in order to support the power demand? Is that net not so great for your business because, well, things are more reliable?
Yeah, that's very true. I think on the context of a broader grid kind of network, right? The ability to kind of shift if you've got a problem in one part of the network to a part of the network that doesn't have a problem. I think in our business, though, frankly, what happens is it's kind of the last mile, right? So you're that line that connects, directly to your home, right? If a tree falls on that line, there's not a lot that AI is going to be able to do for you personally, for your home or your business. And that really is at the heart of our, kind of our resiliency part of our business. I would say that, the other side of this coin, of course, is as we put more data centers on the ground and you see that demand for power continue to increase, if we don't have enough supply, I do think that we're going to have continued problems here. The Texas example that I gave you is an example from several years ago, but what we're seeing is localized pockets where there's just not enough power. That's a problem.
Aaron, someone listening, watching right now said, hey, ask Aaron when the 28 kilowatt generator that you were talking about when you were on with us in August, when that's going to, I guess, be available. Just got about 30 seconds.
Yeah, today. We just opened shipping for the product today. So it's a brand new product line for us. And it's the largest air-cooled home standby generator on the market. So great product.
All right. Good stuff. Good stuff. Hey, listen, we always appreciate time with you. Be well. Aaron Jagdfeld joining us, Chairman, President, and CEO of Generac, joining us from Wisconsin on this Monday.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I want to get to our conversations from the C-suite continuing on this Monday. And something that caught our attention was from our Bloomberg Law team. And they wrote about OpenAI and its most recent update to its usage policies for ChatGPT that provides kind of a window into the company's efforts to insulate itself from potential liability for handing out legal advice to its users. Tim, the company's update, they tweak policies about how ChatGPT and other products can be used to provide legal and medical advice. And although some lawyers prematurely and inaccurately celebrate the changes as an outright ban on giving legal advice, the update was more a change in wording. ChatGPT still produces legal advice, including drafting contracts if asked to do so.
Okay, so a brave new world.
Yes.
Don't take legal advice from us.
No.
Choose whether or not you want to take it from a large language model. Curious what Laura Chambers has to say about this and sort of everything that is this layer of technology that's kind of underlying everything in our ecosystem right now. She's CEO of Mozilla Corporation. She joins us from San Francisco. Mozilla is the global nonprofit dedicated to ensuring the internet remains open, inclusive, and equitable. And you might know the company from its Firefox web browser. And that's really where I want to start and sort of understanding this layer of technology that we're talking about so much, that so many of us are using. And I wonder how you look at it as a way that it's part of the ecosystem now, Laura. Is this like, is it a web browser? Is it like internet access was in the 1990s? Are there going to be no such thing as AI companies because everything is going to be an AI company? How should we be thinking about it?
Yeah, it's a moment of tremendous change. One of the big shifts we're seeing is a really renewed interest in browsers as a category. Perplexity just launched their Comet browser. OpenAI just launched their Atlas browser. And it makes sense. The browser has been around for decades, and it's a product we use all the time, but we don't think about it very often. And it's not surprising that AI companies are getting into this space. The browser has incredible access into credentials, your tabs, where you're browsing, how you're spending your time. And as you know, AI companies are very hungry for that information. So it is sort of a moment of resurgence for the browser right now.
Is the browser the gateway to all of this? Or is it not, because we're using apps like Claude or ChatGPT?
What we're finding is that the folks that created those apps are feeling that the interface is a little clunky right now, that you might be in a browser and then you have to go to another tab and back and forth a little bit. And so I think that there will be a role to play for apps. But what we're certainly seeing from OpenAI and others is that they're really interested in getting into the browser space. But I think the browser's changing. The browser has traditionally been a container. You have a URL and a search bar, you have some tabs, and the browser renders content on the web for you. The shift that we're expecting to see is that the browser will become more of an agent to actually do work on your behalf in that browser interface. But with that shift becomes a big shift in power of data as well. The AIs now have more information about your credentials, where you're spending your time, where you're spending your money. And we know that people are worried about that. 60% of people in the US are really worried about privacy with AI. And the other 40% probably should be as well. And so I think to be successful in this space, people are going to have to go back to those values that Mozilla and Firefox are really built on, which is around privacy and choice and control over your experience and your data.
Do you feel like it's difficult to compete against the behemoths that are out there?
It's always challenging to be a smaller company. The big tech companies consolidate a lot of power. They lock you in. They have vertical integration. But it's something that is incredibly important to do. The internet, if left to its own devices, would always trend to being closed, to being expensive, and to just have a few players. And that's why it's important to have open source solutions. It's important for alternatives for Firefox, like Firefox, to be there. We have our own browser engine called Gecko. There are only 3 browser engines left. Microsoft and Opera, everyone else moved over to Chromium. It's expensive to run a browser engine. I know why they did it, but we think it's incredibly important to invest in options like that, because very quickly, otherwise you end up in a very, very sort of monopolistic world, which is bad for the health of the internet and it's bad for the users of the internet.
So are you creating a web browser? Are you changing Firefox in order to be an AI first browser so it can compete with whatever browser OpenAI ultimately has, whatever browser Perplexity ultimately offers, in the way Chrome changes from Alphabet's Google?
Yeah, at Firefox, we always adapt to where users are going and what they need. And not all of our users want AI. About 12% of users in the US actually don't want AI. So there'll always be an experience for them. But we just launched Smart Windows. We have signups for those available right now, which will be our version of AI. But it's going to be centered on privacy, on trust, and on transparency. So you'll be able to have a great AI experience in the Firefox browser, but it's going to be one that is really oriented around what users really need and how we can do a great job of protecting their data.
Yeah, I am curious too about, you're thinking about who actually owns the data. We know the data is what's going to make AI and LLMs really powerful. So I'm just thinking about, is some of your concerns too about certain companies, again, going back to the big guys, the big players, that they will have the access to most data out there as more and more folks use their search within their AI chat engines, if you will?
Yeah, I think that users should be really thoughtful about their data. Now, the good news about data is it can create great experiences, right? You can have seamless, faster experiences. There's a lot of good things that data can do. But as you give away more and more data, you're actually giving away control. And so the big tech companies control what you see, where you spend your time, how you spend your money by sort of the algorithms of what they decide to show you. And so even though on the internet it feels like you have a lot of choice, actually that choice has already been pre-narrowed, and it's pre-narrowed by the data that's been collected for you. So I think it's incredibly important for users to think about who's got my data, how is it shaping what I'm seeing, what I'm buying, how I'm spending my time, how I'm spending my money, and to not sort of give that data away without really thinking it through, and to make choices that help to preserve privacy.
Yeah, certainly lots of issues. We're kind of finding our way through all of this. Really good to get your perspective. Laura Chambers, she's Chief Executive Officer of Mozilla, joining us from San Francisco.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Yes, indeed, everybody. We're driving to the close on this Monday.
Already?
I know, time flies. 17 minutes until we wrap up the trade on what's going to be a super busy week. As we've mentioned, Nvidia on Wednesday, we get their results. We get Fed minutes. Also on Wednesday, we've got retail earnings coming our way. And then we get much delayed September jobs report now that the government is back open and running. So we'll get that on Thursday. In the meantime, we've got some selling here on Monday.
Yeah, we do. Taking a look, as we just heard from Charlie, at the S&P 500, seeing it down 1.3%, just off our worst levels of the session. The S&P 1.25%. The NASDAQ composite down 1.3%. The Dow down 1.4%.
Yeah, most names in the S&P are lower. Hey, let's get to it with us. Back with us is Sevasti Balafast. She is founder and CEO at Goldvest Advisory. The firm has about $720 million in assets under management, and great to have her back here in our Bloomberg Interactive Brokers studio. It's been a little while. Good to have you.
Thank you.
How are you, and how are you thinking about, I can't believe we're almost ready to wrap up 2025, but the market environment, we talked about Bitcoin, that's pulling back. We've seen stocks pull back, questioning of the AI trade. There's concerns about we don't get another Fed rate cut come December. How do you sum up the market environment right now?
Look, this is a healthy breather. I think it's been a great market. We have to remember that we're still up double digits on the S&P, over 13 or 14%. And tech is up even more. So a lot of clients that had a greater percentage of tech in their portfolios, they're doing great. Even bonds are up. If you look at the aggregate bond index, up over 6 or 7% for the year. So yes, we've had a little bit of a pullback. I think it's a healthy breather, but good results so far for the year.
You said healthy breather a couple times there.
Yes.
Where are we in the breath? Is it the beginning of the deep breath, or is this the end of the deep breath? We're breathing out now?
We'll find out more from Nvidia on Wednesday.
Okay.
We mentioned that, but I think we're still early on in the AI trade.
You're a believer?
I am a believer. This is just early innings. We're still early innings. And there was some recent commentary of, some prominent people shorting some stocks and taking a look and really questioning, do we have the energy capacity that we will need? Do we have all of this? So I think it's healthy, but at the same time, and we'll hear this on Wednesday, it was just last month that the CEO of Nvidia was talking about over $500 billion of commitments that he's already seeing for next year. So I think we're still early innings in this AI trade.
But how do we know it's just not an overspend? And we talk about the circular financing that we seem to be seeing of companies linking up and they do a deal, OpenAI or Nvidia, and then they're, spending on Nvidia chips. It seems a little close.
That's some part of the market. And I'll say some companies like Oracle, for example, are getting their stock prices are down more than others, like Microsoft, that are seeing real earnings and real return on their investment already. So I think it's not going to be the same for anyone. There are going to be winners and losers, and that's not clear already today, but there are some that you can see. So Oracle taking on some debt that maybe they don't, that's raising some alarms, but there are companies that are making real return on their investments.
How do we know that companies aren't signing up to make sure they have access to data centers and are playing around or having access to LLMs, and that they're playing around with it now, but that they're going to say, that's pretty expensive. I don't really need to be doing this. And so we start to see some fallout at some point.
We might see that fallout at some point, but for what we're seeing even into next year, the capital expenditures that companies had talked about are there. And so companies have been talking about that, CEOs. So, it's kind of hard to tell what's going to happen 3 years out, 5 years out.
Fair.
But I think if we take a shorter term view, even in the next 12 months, that's real money that's there. So at some point it will be an overinvestment, but I don't think we're there yet. And we just don't have clarity. As a result, what do? You can't be invested in only tech, right? That's where the diversification needs to come in.
We just spoke with Zach Pandel, head of research over at the crypto asset manager Grayscale Investments. I know you caught part of the conversation. He was talking about the crypto being treated like an alternative inside a portfolio. Are you doing that at your firm?
Not yet. No, we're not. No, we're not there yet. No, we're not using Bitcoin. Similar to maybe what we were talking about earlier, you were mentioning earlier, I also either you're a believer or you're not quite there yet. And the people that are believers, they're backing Bitcoin and see it as an alternative investment. I think there are other better ways to capture alternative investments.
But is it a way that we ultimately are all transacting, and so that we all will have access to it?
Like, I don't see the need yet.
Yeah.
I don't see the need yet. I can't explain it to my clients why you're going to hold this asset that's based on price, the supply and demand. Maybe the price goes up, maybe the price comes down as it is now. I have a hard time explaining to my clients what the fundamental value is. Where is the cash flow? Where is it going to get to?
Which is what you were kind of asking.
Yeah, it was what I was asking, but maybe a better question for him, and I'll ask you this question now because I thought of it just now, is do you have gold in their portfolios?
Okay, we do have gold in our portfolio.
So how do you explain the use of gold?
Okay, so more recently, and since the Ukraine invasion that happened a few years ago now, you have been seeing large funds, large central bank buying of gold in portfolios. And I think that continues. I don't think we're done with that. So you're seeing more adoption and you're seeing more of that buying. And that was a big driver of gold, along with inflation. And gold has been around a lot longer than Bitcoin. And so we've seen the correlation also, if we're worried about inflation, and yes, that is something that we worry about on behalf of our clients, then gold is another better way to put it in your portfolio as an alternative.
But could society at some point rethink of what crypto is and think of it as really like gold? And so we shift.
It could be.
Is it just about perception, or is it real value?
Well, I think it's about perception and the adoption. How much will people start using Bitcoin? I think that's a big part of it.
Yeah.
And that's why some people are taking the approach, again, we haven't done this for our clients at this point, but some people are taking the approach of saying, why wouldn't you take depending on your total asset allocation, take 1%, take 2%.
Right.
It's like a lottery ticket. If it does get to that, some smart people, Kathy Wood, are talking about Bitcoin at, over $1 million. So why not take a small percentage and put it in there?
All right. Sevasti Belfast, thank you so much, of Goldvest Advisory. She's the CEO.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.